All right, so again, welcome back. We are here for one of our big highlights of the Money View Symposium. We are going to have a little over an hour. We don't have to be strict with the time, and we have three amazing presentations ahead of us. And the format we're going to use is that we're going to, just like the last session, hear each presentation back to back to back, and then we'll allow the panel to respond to each other's presentation, and also Perry, if he likes, and take questions from the audience. But before I do so, let me just quickly introduce to you our three amazing panelists, and thank you already for having joined us yesterday. First off, we have Professor Catherine Schenk. She's professor at Oxford University, and she's presenting today a paper on central bank swaps, then and now, swaps and dollar liquidity in the 1960s. And she's co-authored this with Bob McCauley, who I think is also in the audience, and we look forward to having you in the discussion as well. Second is Eric Monet, and I hope maybe somebody can double check if he's here already. Eric already yesterday was the discussant to Perry's keynote. He is a professor of Paris School of Economics, and he's presenting today on central banks, market makers, and shock absorbers. And finally, we have Jacob Fagan. He's at the Berggren Institute, and he's going to present Making and Breaking Monetary Institutions, Lessons from the Making of Soviet and Post-Soviet Monetary Systems. And I think you are really going to be in for a treat. I'm really looking forward to this presentation, and I think there's a lot of overlap with what was discussed in the previous session, so I hope we can get to cover those points. To our speakers, it would be great if we could stay within 15 minutes. It's not a hard requirement, but I think 15 minutes is a nice marker. And if you don't mind, I'm gonna let you know 5 minutes before end and then 1 minute before end. All right, first off, Professor Catherine Schenk.
Great, okay, I kind of timed myself to 20, so I'll see how I do. So thank you very much for the invitation to present. I'm learning a lot. As I revealed yesterday, I'm not a money viewer. So I thought about my presentation and the themes of the work that Bob and I have done and rethought it slightly for this audience. So first of all, in terms of the motivation, this is coming out of work that I did when I was visiting the BIS last year. And obviously it's motivated by the advent or what seemed like an innovation of Federal Reserve swaps in the global financial crisis, and then their renewal in the pandemic crisis. So you can just see the amounts outstanding every Wednesday. And the research that was done on the global financial crisis swaps really pointed to the motivation for those as being depressing the US dollar interest rates or the interest rate spreads in order to, as sort of a signal of increasing the liquidity in the offshore US dollar market. So this is just showing that kind of depression and how the innovation of the swaps did its job and achieved that. So just quickly, in case I do run out of time, the takeaways are really about this earlier period of swaps from 1962 to 1998. They're mentioned in passing by a lot of historians and are recognized by economists, but nobody really talks about them very much. And they're seen as sort of part of the Bretton Woods apparatus for protecting pegged exchange rates. But they survived the transition. And I thought that the origins of them should be interesting, and indeed they are. We find that they were pushed on by the Fed on reluctant European partners. And if you look at the FOMC minutes, the same thing happened in 2008. The European Central Bank wasn't that keen. They would only accept the swap system if the Fed went ahead with its TAF, its TAF. Then they form part of a much wider network of central bank swap lines and cross deposits. And so it's part of a global financial safety net in the 1960s, where it's slightly more articulated rather than embedded nowadays. And what Bob and I discovered in the archives is that they were used to manage offshore funding liquidity just as they were in the 2008s. Okay, so underlying this is the euro dollars that Samuel was talking about. And this is just showing you the increase in the offshore euro dollar market during the period that I'm talking about, which is really about the mid-1960s, both as a share of American GDP and in terms of nominal value. So I've introduced a little bit more, so Bob might find this a bit surprising, that isn't in the BIS working paper that we published together. But I think it's really important, again, moving on from Sungwoo's paper, to note that the ascendance of the dollar that everybody kind of talks about and IPE people are really intrigued by happens at a time of dollar weakness. So when Sungwoo said, oh, well, everybody in 1968 started standing up and saying, we're now in a dollar standard and the world is on a dollar standard, that's because the dollar had fallen off the gold peg. So it was a time of profound weakness for the US dollar. And so the evolution of the swap system also reflects this. So it was a way for the Fed to support the gold value of dollars and encourage overseas central banks to keep dollars in their foreign exchange reserves despite the fact of the weak American economy. So they start, and the BIS has some operations, similar swap-like type operations in the 1950s. 1960, there's a trilateral swap with the Swiss National Bank between gold and dollars. And then in early 1962, the end of 1961, they start piloting forward operations with other central banks, particularly Banque de France, however, can't operate in forward markets, so it gets a bit complicated. And in February 1962, they approached the Bank of England to set up a standing facility. And the archives on this is really quite fun because the Bank of England officials are really not interested at all. They see it as a gimmick. They think they're going to end up holding dollars that are going to depreciate against the pound at this stage, and they see no advantage in it. The advantage they have, however, is about presentational. That central bank cooperation in itself is probably a good idea, and showing that to the world will increase the resilience of the global system. And another interesting aspect of this is that it's not just the Fed. The US Treasury is very in favor of the Fed swaps innovation as well, but for providing the foreign exchange for the Fed to work alongside the stabilization fund. So unlike in 2008, as we heard yesterday, where Bernanke had to kind of go before Congress and explain what he was doing, it's not a case of the Fed versus the Treasury in the origins. In terms of the specific aims, they were really vague. So Charles Coombs, who was the head of the foreign exchange desk, kind of came over and tried to explain why he wanted to do this. And there's not a specific goal. And this was part of the reason why the Bank of England wasn't so keen. But this is what they came up with: counter speculative pressures, in some measure to offset seasonal swings. And that's really important for the story that I'm about to tell. But also for presentational purposes, for window dressing for central banks themselves, in order to kind of, in reporting periods, to be able to bolster their reserves. So this is the system as it evolved. So this is the swap facilities rather than the use of them. And you can see that they increased quickly through the end of the 1960s, again, with the advent of the floating exchange rate regime. So they actually increase after the end of Bretton Woods, and again at the end of the 1970s. And that they're offered to a wide range of countries, most of them obviously advanced economies, except maybe it depends where you put Mexico. This graph, it puts the facilities that were available in the 1960s and 1970s into more contemporary perspective. So it's in relation to US GDP in 2017 and as a share of foreign exchange reserves. So this is really to show the magnitude, and indeed the relative value of the facilities is equal to the value of the facilities that was offered in September 2008. So these are important facilities. They're large, not only in historical terms, compared to what happened in 2008, which was deemed so innovative, but also as a share of global reserves, so as a contribution to global liquidity. And the other thing that comes out of the work is that they were very active. So most of the accounts of these swaps only use year end, what was outstanding at each year end. But as you can see from this graph, there's a lot of quarterly variation. So they often clear the balances of the swaps for reporting periods at the end of the year, But if you look at quarterly data, you can see that they were very actively used throughout the period. So this is the Fed's gross total drawings, and that kind of little peak at the end of 1971, just as the dollar was devalued, they were equivalent to about $30 billion in 2008. And this is the drawings by the partner countries, and you can see that's very active also, but really only up until 1971. And that's because after the Nixon shock, Nixon drew a line under the ability of other central banks to be drawing on the swap lines. He felt that they had been abused as part of speculation against the dollar. So the story I'm telling really is about the mid to late 1960s. And this is a sort of a framework of not all the central bank relationships and support systems, but looking at the bilateral concerté, which was a series of bilateral agreements notified through the BIS, the Fed swap, the BIS's own facilities and Fed swaps in the total. And so this sort of network of the global financial safety net was used to support the pound, the franc, and the Italian lira. And it's not just that they happened at the same time, they were negotiated and discussed at the same time. So when the other central banks offered swaps and cross deposits in September 1966, for example, the Fed also, its contribution, because it's not a member of the BIS, is to increase its swap facilities to the Bank of England. And one thing I wanted to really point out is this extends really late, well beyond the end of the Bretton Woods system. So the final bilateral concerté supports from the European central banks are happening in June 1976 and February 1977 after the IMF, the kind of disastrous IMF drawing in 1976. So I think these are underappreciated parts of the global financial safety net, not just associated with Bretton Woods, but with stabilizing the global monetary system afterward. Okay, the swap that we're really focused on was this special swap that the Fed opened up with the BIS, the Bank for International Settlements. And this was specifically to be used for putting dollars in offshore dollar markets. Okay, so the Fed supplying the BIS with the US dollars that they could then deposit into commercial banks outside of the United States in order to affect LIBOR or limit the deposit rates on the offshore market. So by increasing the liquidity of those markets, by increasing the deposits in that markets, they were hoping to depress the interest rates in the offshore markets to make them closer or to ease the pressure on American monetary policy. Okay, and so this is the kind of work that Bob did, and I think he enjoyed himself. We'll have to see if he'll agree. But he went back into the archives and found into the banking department of the BIS to find when they were doing the deposits, what rates they negotiated with the banks to take those deposits and which banks refused, and kind of collected all that kind of detailed information. And they did this, I think, 5 or 6 times. So this is the first one in 1966. It's December 1966, it's the turn of the year, it's a reporting period where a lot of commercial banks want to reduce the amount of dollars that they're showing in their balance sheets. So there's a tightening of the dollar liquidity in the offshore US dollar market around the turn of the year. So in order to offset this tightening in the offshore dollar market, the Fed swaps with the Swiss National Bank and with the BIS in this kind of more complicated sort of way to generate dollars to put into those offshore euro dollar market to ease that rate. So here we have the blue bars are the BIS deposits, and it's showing the change in the 1-month euro dollar rate, and also the spreads are the other 2 panels against the certificate of deposit rate and the US Treasury bill rate. And they do it, this is several times. Okay, so that's the graph that I just showed. Again, in June 1967, this is associated with the Six-Day War and the tightening of of offshore dollar rates that was expected in response to that geopolitical crisis. Again, at the turn of the year in December 1967, and again for this kind of seasonal tightening. And again in June 1968. Okay, so they're doing this. It seems kind of effective. We'd probably have to do some more robustness checks to make sure, but they certainly thought it was successful. And I think that in itself is important. So Coombs, who was the sort of initiator of the Fed swaps, they meet very regularly on a monthly basis, sometimes even in Basel, in the Golden Foreign Exchange Experts meeting to discuss this. And this guy Daltrey took penciled notes that are still available in little envelopes in the BIS archive, which is where this evidence comes from. So this is how the central bankers, the foreign exchange experts in the central banks discussed these operations. So Coombs comes from the Fed in January 67, right after the first operation, and says, wow, it's a breakthrough. The BIS has operated as a central bank for the international money market. How fantastic. Maybe some agency should take a responsibility for the market. So he, as the representative of the Fed, is very enthusiastic. Later, he hopes that, well, you know, they talk about this in advance, all the European, the sort of G10 central bank foreign exchange operators. And should the BIS be the only one acting, or could there be some kind of concerted action by the other central banks? So the Leutwiler from the SNB says, well, we could do that over the year end. Frasca from the Banca d'Italia, everyone should contribute. And Tungeler about the Bundesbank, well, we'll, you know, if it's very serious, we'll step in also. So again, this is speaking to the very conscious nature of what it is that they were doing and how they were using those swaps and the process of central bank cooperation. Okay, so just to conclude, and I think I might actually be within time because I speak so quickly, I just wanted to kind of point you, I guess, to the BIS working paper that Bob and I produced. If I'm thinking about hierarchies, I suppose, hierarchies of money, I think this fits into Perry's story about the hierarchies of money, and parts of it as central bank swap facilities and that central bank cooperation. But as a sort of a looking at it more in terms of giving perspective on more current events, particularly 2008, maybe less for 2020, thinking about the antecedents to these policies, how they had been used before, reminding central bankers that there were kind of more imaginative ways of using central bank cooperation in the past, maybe even than more recently. I wanted to stress the presentational purpose of the swap system. And as I said, it's clear in the FOMC minutes that when they're devising it in 2007, 2008, this presentational aspect of being able to stand up and say, we're going to have some kind of support system in itself was meant to be calming. So when you're looking at the impact of this kind of cooperation, you need to look at the announcement effects as well as the actual financial effects. That we have discovered, I guess, about the cooperative action to reduce the offshore dollar yields in the 1960s. That it's a big and important type. The 1960s swap lines were big and important, and that the relative size in the operation, the offshore market, again, was sort of analogous to what happened in 2008. So it shouldn't be neglected. What's different is the key role of the BIS in this 1960s network and the kind of the actual functions that they were kind of uncovered deposits that they were making. But maybe this shows a different kind of role for the BIS. The system is curtailed, as I said, by Nixon after 1971. There's a myth or kind of a rumor goes around from the White House. They start briefing the Washington Post and other newspapers that the Bank of England pushed the dollar off of its exchange rate by using the swap. And the swaps kind of lose attractions for Nixon, and he suspends their use. Now the 2020 swaps were different. Non-banks are much larger holders of dollars overseas, and you also had the repo facility. And rather than the European banks being the most drawers in the global financial crisis, you had the Japanese financial institutions are the largest drawers in that kind of brief episode in the 2020. But again, the presentational aspect of the Fed announcing the reactivation of those swaps I think is an important aspect to keep in mind. And this harks back to the beginnings of the swap system in the 1960s. So thank you.
Presentation. I've learned a lot. And I also look forward to, maybe we have a minute or two, Bob, if you have an immediate addition to, since you stated so well in time, Catherine, we can maybe hear Bob. Do you have anything to add right now, or do you want to wait for the discussion? Maybe I'll comment on what Cat.
You're muted, Bob.
No, nothing now. I may come in on the discussion.
Very well.
Catherine did a great job.
Okay, then let me hand it over to Eric Monet, professor at Paris School of Economics. Thank you again for being here.
Thank you very much, Jay. So I hope you can hear me, because the connection seems to be not so well today. So it's okay. So I must start by saying that I had the chance to learn a lot from Perry Mehrling and also Sultan Pozar when I was at the end of my PhD. So I at that time it was really striking. We had these small scale seminars, and I remember Perry and Zoltan presenting all these maps and the shadow banking system and all the what is now called as Money View and well known as a Money View behind that. So it was so it's something that was very important in my training, I must say. And as all good professors, sometimes you forget, whether you know this from Perry or from other sources. It becomes so much into your mind that it's not always conscious whether you bring it or not. So it's so I working on this presentation, I was trying to see how my work that I did afterwards also can be related to the Money View, because at first sight, and it was a problem for me. I remember at the beginning when I was reading Perry's book, that as an economic historian, I was studying time periods where definitely market-based credit was not so much important, while supposedly, I mean, the central banks were still lender of last resort. So what is really new in the money views of Perry about taking all into account this market funding of money market funding of capital markets and also the dealer of last resort. How can you still apply that to ancient times, ancient periods of central banking? So I think it's still very much possible, but obviously it will need some adaptations. So I will briefly give you some example of how we can bring the money views and try also to discuss it, to bring maybe some nuances into some of these concepts and notions to periods before the start of the international money market. So basically before the market turn of the 1970s. So I will start with an example from a recent paper I did with my colleagues Guillaume Bazot and Matthias Maurice on central banks. So before the Federal Reserve, so before where Perry's book on the deal of last resort starts. So you know that with the exception of Japan, central banking was only a European phenomenon for centuries before the Fed was created. But these institutions were very, very important in Europe. And let's start here from this quote from the great book by Carl Polanyi on the Great Transformation. So Polanyi is sometimes known, and I think wrongly, as saying that there was no independence at all of monetary policy and central banks during the gold standard. And I think this is the wrong interpretation, because if you look at what he wrote, on the contrary, it was very clear that for him, a very key role of central banks during the gold standard in the late 19th century was to serve as a cushion against the international shocks that were driven by the fixed exchange rate system. That's the underlined sentence here. So unless the shock was cushioned by the means of independent central banking policies, all these open economies would not have been able to survive in a world of internationalized global markets, sort of the 19th century. So how did the central banks work as a cushion during that time, as a shock absorber, we could also say? So it's something that we try to do in that work. So it was not so difficult to understand, actually. You see that at that time they had a fixed discount rate and they could discount commercial bills. They also used Lombard loans, so it means advances on securities. So actually not so far from what we would call repos today. And I think it's also important that they used a lot these facilities. So they made a fixed discount rate and they lend freely at this rate. So when money market rates increased, when they are driven, for example, by international shock, it could be a financial crisis abroad, or simply when the leader of the international monetary system, the Bank of England, increases its discount rate through the exchange rate. This is going to affect the money market rate of these countries. And then when the money market rate is approaching the central bank discount rate, most of the bank go to the central bank, they borrow to the central bank. And then you see the consequence of that is that there is an expansion of the domestic loans of the central bank after an international shock, while at the same time, the central banks are decreasing their international assets. So there is this adjustment mechanism that is working during the system, and that's how central banks actively, but not really deliberately, as Bloomfield said. It's not deliberate because this has not like open market operations where they are going, or QE where they set an amount that they want to buy on the market, not at all, but actively they work as a kind of automatic stabilizers or a shock absorber on the market. So something which is quite similar to the role these central banks and actually most well known had in taming seasonal cycles. Something also there have been a lot of discussion on the role of the Fed when it was created on taming the seasonal shocks on interest rates, and Perry talks about that in his book. But I want to emphasize that it was not only done through the standard commercial loans thing. I mean, to do that, the central banks have sometimes to add a variety of collateral to their operations. And if you look at the detailed balance sheet of all these central banks, it's increasingly diverse, and it depends a lot on the characteristics of the local economy. And obviously, the US lacked discussion before this shock absorber before 1930s, and it's also something we show in this paper, that the US money market rate reacted much more than interest rates in other countries to an international shock that in this case we measure as an increase in the Bank of England interest rate. So if you want to see that in a graph, this is what happened to central banks' balance sheets when the Bank of England, so the leader, the conductor of the orchestra, as we often say for the gold standard, did. And this is a panel of other central banks with monthly data. And you see that, not surprisingly, here the exchange rate is depreciating. The international reserves are going down. And the question here is that the domestic portfolio, so the domestic loans are going up and serving as a counterweight to the loss of international reserves. And so the domestic interest rate only increased by 20% of the value of the Bank of England increase. And if you do that for the US without a central bank, you see that the interest rate increased more than twice as much. So it would be 0.6 or 0.7. So this is what we call the shock absorber. We have also a companion paper to do the parallels with what happened during the Euro crisis, because if you interpret the Eurozone today as a fixed exchange rate zone, and you see that in one way you can interpret the ECB policy, and so also the imbalances into target 2 as this role of absorbing shocks within a fixed exchange rate zone. And then it's normal in that way that trying to maintain quite a stable interest rates across Euro area countries, then you see the balance sheets of diverse national central banks within the Euro system expanding with different degree and different volume at different times. So now I shift very briefly to the second example of role of central bank. I want to emphasize here is I call that market makers. And all this, I'm working on this for a new book. I hope to publish one day on that. But I think it's a very important role of the central bank, which is, again, I think it should be reintegrated with the money view. Is how central banks really build markets. They build markets. So there have been a lot of work in a recent decade on early central banks, but it's actually what we learned from this period. I mean, that central banks were settled our clearing parent systems between local bankers, and so they are building a local market of settlements, actually issuing a kind of safe asset that the local bankers can trade for settlements. In the 19th century, and again, there have been a lot of historians working on that, the national central banks, they played a huge role in unifying credit markets across countries. This is one reason why all these European central banks and also Japanese has all these many branches all across the countries, because they wanted to provide access to credit with a certain form of collateral all across the territory. In doing this, they are also creating market because they are standardizing collateral. So there are some assets that are going to become more accepted and to circulate more because of this I will say, big push of the central banks. In the 20th century, and it's something I worked more at the beginning, there is also this role, especially in the period from the 1930s to the 1970s, in this period which is sometimes called the developmental central banking role, where central banks are going to play more and more important role in industrial policy, or is what is called credit policies, to support the development of the economy and also economic planning in some industrial sectors. So how did it work? And it's a system which is not always very well known. There was a close interactions between the central bank and developmental banks, public banks in the countries. And so these public banks, what their role usually is to fund long-term credit. And usually they issue bonds, long-term bonds on the market. But these long-term bonds, especially in some countries, and it's true in South America, for example, these long-term bonds, they are not always very much accepted because they are not always pure equivalent to government bonds, or government bonds are not very safe. And so the central banks, they discounted these bonds of the developmental banks. And doing this, they really created a market, also created a market for these bonds. So there was a very close interactions between these two kind of engines of the state, the central bank and the developmental public bank. And in that way, the central banks really played a role also in creating the market and by taking that at collateral. So it's why also in these countries, you see central banks doing midterm loans, sometimes up to 5 years, to these developmental banks, actually. So as a conclusion, I think the money view is very important for economic history of central banking and monetary policy. And now I see a lot of work by scholars working in this area, that as the money view actually argue, it's better to focus exactly on the central bank's operations and the kind of collateral which is accepted, the close connections between the central banks and the financial systems, rather than what some kind of economic history of central banks used to be in the 1980s and 1990s, focusing on interest rate, central bank independence, and money supply. So these have changed quite the focus here. So I think that the two examples that I have here is to provide some examples where there are some building blocks of the money view, which is for especially the clear distinctions between market liquidity and funding liquidity on one hand, and between dealer and lender of last resort on the other hand, is not always obvious. And one of the reasons for that is that actually, even in the old systems of commercial loan theory, as Perry said, or on lender of last resort, actually the central banks were already playing a kind of role of dealer of last resort by accepting a lot of collateral to play a role as shock absorber on the market, and also building the national markets of credit. And so these are all these kind of operations that I think is fascinating for historians. And I think for them, you can bring the money view to that, but you need some kind of adaptations, especially this acceptance of these long-term loans by central banks. Even also, I didn't have the time to talk about that, but capital controls that could be implemented by central banks and the non-convertibility. So it's very important. So how can you integrate that? So yes, there's a lot of things to do and to get the money view in the back of your mind and study economic history. So it was only a few examples here, but open to discussions, of course. Thank you.
Thank you, Eric. You have a minute left on the official time. So that's great, really fascinating. And maybe we get to the credit control aspect, since you have a whole book on that in the discussion as well. But let me hand it over to Jacob now, and let's see if his computer works.
Oh,
He was worried a bit earlier.
Are
You
we
got
good?
it.
Yeah. Okay. So I am going to do something slightly different because I am a banking historian, but what I'm presenting is the last part of my book, which is coming out soon. And I think it will, what I want to do with this presentation is show how the money view can be used to kind of deploy into political economy and into a traditional archival history. And starting this presentation, what I'm going to do with it is I'm going to take you through the Soviet collapse and show you how it goes from, in the kind of terms of Perry Mehrling's work, from the world of Gurley and Shaw, of extreme financial repression, right? And into the world of Hyman Minsky, and precisely of the moment where we get the term the Minsky moment. And I'm starting this off with a quote from Albert Hirschman on the politics of inflation. Because I think, as we actually have discussed with Perry before, the inflation rate, right? The price level question is the thing that was missing from the money, right? And my other contribution here is to use the money view to explain the price level as a political phenomenon running out of distributional politics. And my third goal with this presentation is to take the Soviet collapse and its transition into a capitalist country and use it to kind of, and explain it as a microcosm of what happened in the late 20th century. And then if I have time, compare the same phenomena, the same political and institutional phenomenon through the money view with the changes we saw in the United States from the 1970s onwards. And you'll actually find that, shockingly, there's a lot of similarity because we're going through a very similar social process, except that's far more extreme than the Soviet Union. So to get at where we're going, we have to understand where we started. The USSR, and I always like to use the Stalin quote from 1941 about what the goal of this original planned economy was, is perhaps the most effective story of financial repression in world history. The consumption rate, which I've kind of charted here in two ways. One is the official Soviet statistics, which uses a slightly different approach from GDP shares and then a moving average of GDP shares, is extremely repressed compared to the rate of investment. And that's done for a reason. Very explicitly, Soviet development theory assumed that consumption should be extremely repressed so that investment moves into the means of production, right, of heavy industry, which in turn is supposed to, at some point in the future, create the basis for more equal consumption. And we can see that, and so that means that there's a shortage economy, right? We're living in a kind of shortage world. I'm sorry, this is out of order. And we can represent that as a set of balance sheets, right, of an extremely closed, financially repressed economy, where we have a household, the state budget. I'm sorry, that is, something didn't render properly in my PowerPoint, but that's fine. The household budget, right, which is being forced to maintain either large cash balances, one a state budget that can work in a consolidated way as almost a large development bank, and then an enterprise budget, which is essentially expanding goods for credit, right, out of the state budget. This is an extremely inflationary system because what you have is large amounts of cash, right, chasing a limited amount of goods as designed. So how did this system get controlled? The first way it gets controlled is actually, as we know, like for major goods, there are fixed prices, right? That's the classical, communist system. What most people don't know is you actually have two sets of money. And you have to, oops, this is not running the way I want it to. Apologies. I'm sorry, it is 7 in the morning here. Well, on the West Coast. What you have is actually two sets of money. You have what are called money for for wholesale goods, which are settled within enterprises that only enterprises can have, right? And then you have goods that are money that is a circulating set of goods, which only households can use for consumer goods. And separating that market allows you to essentially have a foreign exchange rate within one country, which is rather unique. Yasushi Nakamura, who's done a lot of work on trying to figure out how this system actually worked in practice, found an incredibly interesting result. The fact is, having an internal exchange rate between two sets of money prices is very good at controlling the rate of inflation on consumer goods, because what the state did was it would either increase the amount of cash in circulation or decrease it by just simply using the exchange rate between the two cash values to take money in or out of circulation without actually sucking off the credit to state enterprises. There were leakages, but these two exchange rates actually do a really good job in forcing the price, what should be a hyperinflationary system to only be one which has shortages, right? This lasts until something changes. That change is perestroika. And as part of perestroika, you have a small opening towards the legalization of cooperative businesses and, most importantly, cooperative banks. And what cooperative banks do is they are designed to fund these small cooperative businesses, which are supposed to be essentially subcontractors of the large state enterprises to get more efficiencies. But in practice, what they do is they begin to become tools for what people call nomenclatura privatization, which means insiders within enterprises, usually managers, are able to use the banking system to gain control of enterprises as private actors. That's a well-known story. The less well-known story, which you can present in kind of balance sheets, right, is that these things began to be a bridge between the two money systems. They began to be an extra place where that exchange rate that could once only be set by the central bank could be done within the commercial market. So what I've done here is I've presented this new actor here, the private enterprise, the private bank, within the ecosystem that existed before, which was this closed loop between the household, the state, and the state enterprise. And what you find is that the enterprise, that the bank has assets, right? And there are a variety of things here. I'm not going to get into them because I use this presentation all the time. There's actually no tax system yet. They don't know how to tax these things yet. They haven't developed that, nor have they developed a way of creating interest rate. That's actually part of the debate that's going on between 1989 and 1990, is whether a quote unquote communist state can have income taxes because everyone's supposed to be equal, and whether it can have a modern central bank because that's a capitalist practice. But what they've done is they've actually created a capitalist practice. They've created private banking by legalizing these small scale cooperative enterprise banks. And what these things are doing, is I've circled here, is making a market between enterprise scrip and wholesale currency, between wholesale enterprise scrip and house and currency that can be used to buy market goods. And what they're essentially have constructed here is they have using by essentially taking in being the intermediary between state enterprises and cooperative enterprises. They construct a swap between the two currencies in which they take in enterprise currency and they reissue at a preferable rate commercial market currency, right, which you can buy goods with. And they use this to essentially do insider privatization in a way in which enterprises will then subcontract with private businesses that are owned by the same people that run the enterprise, and they're converting these illiquid enterprise money assets into liquid currency that can be used to buy goods. And that opens up a credit money system that already looks like something like a capitalist economy, but also it opens up an inflation channel, right? And this is some data from that I found in the archives in the Ministry of Finance. And in the note in which this data is drawn, they find something quite interesting. There are incomes from financial assets that don't exist before, because financial assets don't really exist in 1988, that suddenly begin to appear in 1989 when these reforms are taken in. And then there are incomes from what they call balances that cannot be captured, because they haven't developed the state apparatus yet to live in a financial economy. There's no understanding of where this credit money is coming from and how it's moving into incomes of households. The tax apparatus hasn't been established yet. They simply book 6 billion of it, which is a lot for the general budget, right? The overrun into an area that they say they don't understand because it's credit, and the Ministry of Finance very well says is we're not able to accurately understand the demand for money anymore because we haven't developed a system of monitoring it and taxation. And what we really need is to develop private business taxation in order to understand the level of demand for money, right? Now, fast forward to about 1992 as we formally built a capitalist system. And we have a very interesting banking system that has emerged, right? We have a banking system that's extremely limited to government insiders, that is forced and that owns a state bank, so we have the Sberbank, which is still a major deposit taker in contemporary Russia, right? Which is taking something like 50 to 60% of household deposits at one interest rate, right? And then using the massive rate of inflation to then speculate on foreign on FX and on goods, right? While also still being an intermediator on guaranteed loans to state enterprises from the central bank, which is a Soviet practice that lasts into 1994, 1995. So you've got a banking system that's extremely profitable and making a lot of deposits, right? Pushing up the money supply. That creates a huge political problem for the central bank as it's trying to trample down on the inflationary pressures, because it has to make a deal with both the enterprises, the commercial enterprises, which are really dependent on this flow of credit, to not shut down and not have vast unemployment, and with these insider-owned banks, which are making money hand over fist over the effective negative interest rate they're charging to depositors, right, due to the high rate of inflation. And the way they do that is twofold. They make a deal. They start printing what are called GKOs, which are short-term government bonds, right? Short-term notes. And they make initially insider banks the only buyers and marketers, and thus later on marketers for these things, right? And as you see, the profit rate, the profits from making the spread on the deposits due to high inflation, right, begins to go down, and the marketing profits from the GKOs begins to go up. The other deal they make is they make state energy firms essentially write down the energy costs and the for state companies, right? So that central bank support for state companies can be pulled out. And they also make taxes payable in goods so that there's less circulation, money in circulation. And in 1995, this actually finally works to arrest double-digit inflation. But what happens next? What happens next is in 1996, the next year, they begin to realize that the GKO rates could be very, very attractive to foreign investors. And they begin to use a market that was once restricted only to insider banks as a way of creating a political coalition to restrict inflation, right, into a global market. So what begins to happen is you have these new foreign banks investing into GKOs mostly from East Asia, actually in Brazil, as we found out later on. Those are actually major players in the GKO markets, more so than the usual players we know from Wall Street. And the Russian banks begin to see another profit opportunity. Not only are now they owning only 50% of the GKO market themselves, they're also making forward agreements, right? So they're making what these classic kind of Perry Mehrling, I'm not sure if you guys can see my cursor on the screen, there it is, right? They're making these forwards that are unhedged for foreign banks that are held in the GKO market in order to control currency, in order to control their currency risk. And they're making money hand over fist with this, right? These are these infamous oligarch banks. And with that money, they're also buying up the Russian economy in the loans for shares schemes, right? Where they're issuing loans to the state in order for shares in real enterprises. That all works really well, these foreign inflows, until it doesn't in 1997. And this is where we start getting the first term of when Bob Macaulay uses the term the Minsky moment, which is the 1998 Russian financial crisis, right? In which a rapid withdrawal out of that, carry trade between the high GKO interest rate and local interest rates suddenly crashes the economy, and you see eventually the IMF converts GKOs into international, which are local currency bonds, into international euro bonds. So kind of through the money view, you've seen how the system transition from a very financially repressed system, right, to a Minsky style unstable financing system can be understood as also a political process of distribution, right, within elite groups and between elites and households. Now, with the time I have left, which is actually probably not that much as I'm checking on my timer, I want to kind of make a few summary statements as to why I think this narrative and this method is important. What we're seeing isn't just a post-Soviet phenomenon. It's one that I think we can extend to most of the industrialized world. The collapse of financially repressed systems due to inflation, which is also driven by energy costs on both sides, something I didn't really decide to get into, has a direct effect on the political coalitions that drive financial liberalization and have ended us into, the world that we're seeing today. Much like in the Soviet Union, in which as Professor Schenk and has described, we had, a very controlled set of swaps controlling international currency rates under the Bretton Woods system. The emergence of the Eurodollar, of Eurodollars creates a new set of challenges and new institutional realities, right? And I think this is really well covered in the new Lombard Street. This is something that starts as just a technique around getting around Bretton Woods that begins to take up a life on its own, just like co-op swaps did. And you have what I think is, at least in the United States, a new form of distributional politics, much like you had in the Soviet Union, which is the financialization of real estate and the creation of real estate as a high interest rate special kind of asset that's given to a particular section of the middle class in order to facilitate facilitate the Volcker shock and the secular decrease of the labor share versus the capital share. I think thinking in these distributional terms and in this system transformation term can give us a lot of insight into what the money view really lets us do. The money view is a micro tool for understanding macro political phenomena that are ultimately rooted in distribution and in distributional coalitions and how they use use financial systems to distribute assets. That's my presentation, and yeah, I think I'm done.
Well, thank you, Jacob. And I think we just heard three fascinating presentations. I can't wait to get into the discussion. The way we would like to do this now is just briefly hand it over to Perry to make some remarks. And I also would like to then maybe hand it over to the panel to make comments on each other's presentations, if you like. I also saw that, Bob, you had some reactions about the last presentation. Perhaps you also want to get into that. But Perry, I think let's just start with you to have a quick round of reactions from you.
I wasn't expecting to get called on, but maybe you saw me in the chat. I was being rather active in responding to these papers. Maybe the most recent one, I just draw connections between what the story Yakov just told about Russia and the story you told about Germany. I mean, they're basically very similar. These sort of dual circulation systems and control. When you're and the Russian problem, which Yakov doesn't emphasize, but the foreign aspect of this is very important at the very beginning, which is they're basically cut out of world capital markets. So they are forced, in the first 5-year plan to repress consumption, and there's just no other choice. They cannot. They have. Very similar to the German situation, right? So they've invented the same tools, and that's that I would be very interested in having conversation between you two. I've been having lots of chat in the also about Eric Monet's paper with him. One of the things is that I want to emphasize is that the money view framework, these two ideas of the payments of the survival constraint and the dealer function, grew out of Stigum. So they grew out of bank lending world, okay, and they were then applied to shadow banking. That's where Eric saw them, okay, but they were not developed for that purpose. They were developed actually for a traditional bank lending thing. So it's now he's back. He's reverse engineering, and that's fine. The second thing I would say about Eric, is that my reading of Bagehot is that basically modern understanding of lender last resort is not Bagehot. That Bagehot is very much dealing with the bill market, and that's why we titled our paper "Bagehot was a Shadow Banker," to emphasize that the dealer markets that are making money markets go in the 19th century are analogous to what is happening in the 21st century. It's just that there was this long period in between when these markets all closed down, and so all this knowledge got lost. And when you read Bagehot, you read him through the lens of modern repressed American banking in circa 1950, and they didn't understand these texts. Okay, I think that the world of Bagehot is very much more like our present world than basically anything in between in those 100 years, and that's what we were trying to emphasize. This paper by Schenk and Macaulay is just fantastic, and really great. I saw the presentation that was done. I think it was with the BIS, and Adam Tooze and other people were on that. So this is the second time I've seen it, and it's even better. So it's fantastic for bringing to light. Now I'll link that to Kindleberger here. That behind the scenes, that so the whole point of Charlie's 1937 thesis, okay, is to emphasize the importance of short-term capital flows for dealing with balance of payments problems, smoothing this stuff out. That if you have a fixed exchange rate, you can't move the price, so you got to move the quantity, and that's what the FX swaps are doing. I will at the official level, there are dealer markets, that are, but they're moving prices. So if they don't intervene unless they move prices. So if you don't want to move prices, you're going to have to use FX swaps. And so this is exactly what Professor Schenk is pointing out, the amount of official credit flows that are needed to stabilize that. The last thing I'll say, impromptu discussant, is I don't know that I said it yesterday, but it's so fascinating, this evidence she's dug up about this quote about that the BIS is acting as a central bank. Yippee, says Charles Combs. Okay, so if you haven't read Charles Combs' Arena of International Finance, which is his memoirs, this is just a fabulous document, and everyone should be reading this. It's just great. He's a good friend of Charlie Kindleberger's. Charlie is, he grew up in the New York Fed. He has connections with that. He knows all this stuff is happening behind the scenes, okay? But he is not speaking about it openly. Every now and then, though, you will see it in his papers. That quote I gave you yesterday from 1970, where he says, in the dollar system, we need to bring in other people to it's not just the US dollar, it's everyone else's. And Bob McCauley said, yeah, he wanted to have Germany on the FOMC. That's true. Even more, he wanted the BIS to be the world central bank. He's in print saying that he really thought that global money should be managed out of the BIS, not out of the Fed. Okay, that because the important global money was the offshore system, and he's looking forward to that day, but he's not sure that the cession of sovereignty will work, with political constraints. So this was a fascinating piece of evidence that to me, I've always felt that he was swimming in these waters, but was not, but behind the scenes. Remember, he grew up in the OSS, so he's very used to doing things behind the scenes, and that, I think, he knew all of that stuff. And so these are connections. I'm so glad to have made to no longer be a stranger to each other, because there's so many intersections here. I'm just looking forward. Is that what you wanted, Jay? You should have warned me.
I did actually just check your chat log. You've been chatting with so many other people.
Oh no. Okay. All right, go ahead.
But no worries, you did well. I would like to just hand it right back to the panel, starting with Professor Schenk and Bob McCauley, and then go to Eric and Jacob, just to give your reaction to what Perry said and also to the papers that were presented.
Thanks. I'll start again, I think, and Bob can kind of follow up. So thanks very much for those comments. And again, the papers were really fascinating. I think particularly Eric's understanding or kind of highlighting of the very changing nature of what central banks were meant for over time is something that gets forgotten by economists who are caught up in central bank orthodoxy of the last 30 years and reflecting on these previous types of instruments, but also types of roles. So the Bank of England, for example, had a very large balance of securities, had a huge amount of BP shares, and other kinds of more active policies, indeed, in the interwar period. So I think that's important for us to understand as we may be perhaps going into a different kind of central bank orthodoxy moving forward. And thank you also. I think it has been a real kind of learning experience for me taking part in this. So thank you very much, Perry. I think maybe I'm a Money viewer and I have never really read the Money View. So maybe I came at it from a different kind of perspective. The only other thing I wanted to bring in as we were talking about the BIS is to remember about the IMF and its role, and indeed the way it was sidelined during the 1960s. in the same kind of way. It was kind of sidelined after 2008, partly because of the conditionality. But quite crucially, if you look at the global financial safety net of central bank lines of credit amongst the bilateral concerté, the European central banks, there is an IMF backstop in the end. And that's when Britain has to go into the IMF in 1976. It's in order to pay off the swaps, the 3-month swaps that they had arranged beforehand. So again, if we're thinking about innovations in the swap system and a way to broaden that out to a wider group of countries, some kind of institutional innovation, maybe the BIS, maybe the IMF, maybe creating backstops, would widen the range of countries who could take part in this kind of network. Thank you. Bob?
Just on Perry's point, I guess I liked Coombs' book more before I worked in the archives with Catherine. He turned out to be a very unreliable witness to his own career when he wrote that book. So you never get any of the action that we're describing where the swaps are going to the BIS and they're not going to support the exchange rate grid. They're going to stabilize US dollar interest rates offshore. That's completely absent from the book. And Catherine tells me that any decent historian knows better than to depend on memoirs, and that's
Absolutely.
Just a
Absolutely.
point. On Eric's, I like the line that Lombard loans are like repos. That's my takeaway. And it seems to me the history of the repo market in the United States remains to be written. My impression is that the instrument actually arises through Salomon Brothers and the other non-bank dealers getting squeezed at times and approaching the Fed for money. And so kind of a reverse inquiry compared to the way repos are done now, where the non-bank dealer was approaching the Fed at a time when interest rates were high, where credit was stringent, and then it evolved in a quite different direction. But maybe that's a little more like the spirit of the Lombard facility, as you describe it. Yeah, I'm very struck at your description of what happened in 97, 98. I never had it so lucidly put before me. So the carry trade was not the foreign banks. The carry trade was the local banks that, as you're describing, were doing naked swaps.
Yep.
So making money as long as the exchange rate held, and then defaulting when it didn't. It reminded me of Paul Volcker went on to the board, I think, of Bankers Trust in time to be there for the 98 crisis in Indonesia. And he said, recalling the case later, that Bankers Trust thought it was dealing in derivatives, but it turns out they were making loans to the Indonesian banks, essentially paying out option premium on the exchange rate to the Indonesian banks, who knew better than Bankers Trust that if anything really went wrong, they would just default on the options contracts.
And I'm assuming the Indonesian banks are just as insider held as the Russian ones.
Yeah, there was a wide range of governance circumstances. Let's put it that way.
Yeah. I was really struck by Eric Monet's paper because I think it actually made me understand the plight of Jay Powell much better than I did before. Insofar as there's a paper by Ben Brown, who I really like, that almost argues, I think correctly, that central banks are kind of becoming forced to be incipient planning boards for late capitalism, is the way he puts it. And I think thinking through like Eric's work, and I've read your book actually really recently in relation to my day job, which is as a policy writer at a think tank. Thinking of maybe that's not new, like the developmental function of central banking has been there for a long time because, well, they started as the state's banks to begin with, right? Like that's what the BOE and the Swedish central bank apparently came first. if I remember correctly, was doing initially, and this kind of understanding central banking as a moving phenomenon, right, between kind of market management and the management of state money, right? That makes me understand why central bank politics in the United States, at least now, and in Europe, look like the way they do, and that central banks really, really are screaming at the fiscal side to kind of complete what had been a completed system beforehand, right? In which the central bank is doing a much more developmental function at some point in its history. And then, at a different point in its history, it's doing much more market management, right? As for some unknown reason. And, Eric, I'm wondering if you kind of are thinking that way. And if there's that paper Zoltan wrote with Macaulay, right, about like something like, I think it's called like How I Stopped Worrying and about what is it, like How I Stopped Worrying and no longer cared about central bank independence or something like that. And I feel like that's kind of that like historical cycle is really present in your presentation. And there's also a different paper that my colleagues Salia Marova, who I work with now, and Bob Hockett recently wrote, calling essentially for like a formal third leg to the stool of management, that there is like there's monetary policy, there is fiscal policy, but there's nothing bridging them as an institution. They're actually formally calling for a separate development bank almost in the United States, right? That does the role that the Fed kind of forced into with the 13.3 facilities, when that Congress politically can't do because the fiscal authority is too short-sighted, and that there should be like something in between them in order to get rid of all these kind of institutional conflicts, right? Where not forcing it on and allowing that function to be more formally run. That was, I think, like as you were giving that paper and those changing circumstances, I was just really like thinking through like, aha, we're living through the cycle again.
Yes. So should I? So I will be very brief because I think we're pretty late. But yes, thank you. Thanks, Perry, for your remark. I must say that you're right that in the paper called Badger as a shadow banker, you clearly explain what actually that Bayjot view already has this idea of market liquidity and dealer of last resort. So it's very useful paper in this way, because you also actually introduced what I said in my conclusion, that we have to have these nuances on the distinctions between market liquidity and funding liquidity. So sorry, I was more in mind. I have more in mind your book, and I forget this paper, which makes it very, very clear, and I think it's very useful in that way. So I will it will take a full discussion, so I will also be very brief on the other remarks. I think it's to also link these different remarks. It's also something which is quite frustrating when you are studying countries, I would say, outside of the US and the UK, and you know that most of the intellectual apparatus that are used to apply to central bank have been shaped in this country. When I like very much Bayjot, but it's true that it's a very nice description of the UK markets in the 19th century. I think it's not very appropriate for some time. It is missing a lot of important institutions in other countries, in continental Europe or in other countries, which have been very important in the 19th century and 20th century. And I mentioned them briefly, but in many countries in continental Europe, in Asia, in South America, Africa today, you cannot really understand the monetary and financial system without understanding the links between the central bank and these public development banks. I mean, a lot of countries we know in the 19th century, they set up these big public mortgage banks, and usually they were the twins with the central bank. I mean, in Italy or in France, country that I know most, they are the same statuses. I mean, they are built to perform these dual roles, one on the monetary side, the other on the mortgage side. But these are and they are connected also through financial transactions. In many countries, this is it. I think it's very important to understand that the central bank was not the only state institutions of intervention in the financial system, and there were obviously links between them. And there are cases, interesting cases in the 19th century. Italy was that for some time. Austria also, where actually the same institutions play these two roles. So the same institution will issue on the liability side, you will have both money and bonds, for example, and then they were separated. So it's only one example of what Yakov said. Actually, of this, you see that the institutional form of central banks have been extremely diverse across history, and it's the same with the definition of central bank independence. I always give this example of the 19th century central banks. Most of them were seen as independent. I mean, the debate on central bank independence was very much discussed in the 19th century. And they were private. So since they were private, they were usually thought as independent. But again, in many countries, central banks could finance the government directly, but it was but with a limited amount, which had to be voted by the parliament every year. And for decades, this was not seen as something going against central bank independence. So you see that, and when today it's completely not appropriate with our definition of central bank independence, but definitely I know it's extremely general as a conclusion, but the role of central bank and the definition of central bank independence has varied so much in history that it's for sure that we cannot think that the current model is there for granted. For sure, it will change.
Well, thank you, Eric, and thank you to the entire panel. I think this is a good place to end the session. I know we didn't get to the rest of the audience, but I feel like we participated vicariously. And again, we have the liquidity happy hour to dive into particular points again.